We've all seen those headlines, right? The dollar is weakening. And your first thought is probably, uh-oh, that can't be good. But here's the thought. What if a weak dollar isn't actually a threat to your portfolio? What if it's a huge opportunity in disguise? Well, today we're going to dig into exactly that, how to play this to your advantage.
Yeah, that's really the big question, isn't it? We're going to pull back the curtain and see how a falling dollar can, believe it or not, pump up corporate profits, totally change the game in commodity markets, and, most importantly, give you some real, actionable strategies for your own investments. Okay, so before we dive into the deep end, let's get our definition straight. What does it actually mean when you hear the dollar is weak? Let's break it down, no jargon allowed.
Honestly, it's pretty simple when you boil it down. A weak dollar just means your greenbacks don't go as far when you're buying stuff in other currencies. So, imagine this. Yesterday, $1 US could buy you a full euro. But today, with a weaker dollar, maybe it only buys you, 95 euro cents. That little gap right there, that's the weakness we're talking about. And this really shows you how there are two sides to this whole currency thing. When the dollar's strong, it's awesome for us as consumers, right? That vacation to Italy suddenly gets a little cheaper, and so does that fancy imported cheese. But when the dollar is weak, that's when US companies that sell their stuff overseas start celebrating. All of a sudden, their products look like a total bargain to anyone paying in euros or yen.
All right, so let's pull on that thread a little bit. How does this actually work? How does a slight shift in currency value ripple through a giant multinational company? Well, it turns out it's all in the accounting, and it's actually pretty fascinating.
The key phrase you need to know is translation gain. And get this, it has nothing to do with selling more stuff. It's not about more sales. It's all about the value of the money a company has already made, but in a different currency.
And this is a perfect example of how it works in practice. So look at this. A company's European branch earns €1 million. Simple enough. But when they have to report that profit on their US balance sheet, the exchange rate has moved against the dollar. So that very same €1 million is suddenly worth $190,000 more than it was before. It's like free money, a paper profit that comes purely from the currency shifting.
And believe me, this isn't just some boring accounting trick. It has a huge real-world impact on the whole economy. Just look at the period between 2005 and 2008. The dollar was weaker then, and it made U.S. exports so much more attractive that it actually helped shrink the entire U.S. current account deficit to just under 3% of GDP. I mean, that is a massive economic shift, and it was driven almost entirely by the value of the dollar.
Okay, let's switch gears a little. How does this weak dollar thing affect another huge part of the market? I'm talking about commodities. For a long time, there's been this predictable dance between interest rates, the dollar, and the price of stuff like oil and gold.
Yeah, for ages, there was this kind of unwritten rulebook for investors. The cycle was clear. The Fed cuts interest rates, commodities hit their low point, and then the dollar starts to climb. You could pretty much count on it. But, and this is a big but, sometimes that rulebook gets completely tossed out the window.
And this is where it gets really interesting for us. See, it's one thing to know the pattern, but it's another thing entirely to know when that pattern might just break. And in 2008, boy did it break. The market just went completely off script. Just take a look at this chart. In the first part of 2008, the dollar was falling, right? It dropped about 4%. Now, according to the old playbook, commodity prices should have been down in the dumps. But nope. Crude oil prices skyrocketed by over 20%. In the middle of all that chaos leading up to the financial crisis, the old rules just went out the window. The relationship between the dollar and commodities completely flipped, which, as you can imagine, created a ton of headaches for some, but also some incredible opportunities for others. Okay, so this all brings us to the big so what question. How do we take all this theory about currency movements and accounting gains and turn it into an actual, concrete strategy for our own portfolios? When you see the dollar start to weaken, what are the moves you can actually make? Well, it really boils down to four main approaches. First, you could go direct, invest in the foreign currencies that you think are going to get stronger against the dollar. Second, you could take a broader approach and invest in the stock markets of those countries. Third, remember that translation gain thing we talked about? You could target big U.S. companies that make most of their money overseas. And finally, of course, there's the world of commodities, which often move in the opposite direction of the dollar. And you always have to remember, this is a global game with two sides to every trade. For an investor here in the U.S., a weak dollar can really boost the returns on your foreign investments.
But flip it around. For an investor in, say, Europe or Japan, their stronger currency means they've got a ton more buying power. For them, US assets, everything from stocks to real estate, are basically on a huge discount.
So we kind of end up right back where we started. Is a weakening dollar a warning sign, a signal of things like inflation? Yeah, it can be. But as we've just seen, it's also this incredible engine that can drive profits for US companies and open up some really clear opportunities for savvy investors. In the end, it's not about whether a weak dollar is good or bad. The real question is, do you know where to look for the opportunities it creates?